Chapter 3 is all about the adjusting process. We've learned how to make our everyday normal transactions. We've learned how to post those. We've learned how to make our unadjusted trial balance. So now Chapter 3 is focusing on our adjusting entries. Adjusting entries are a planned part of the accounting process. The reason we have adjusting entries is because we are trying to accomplish matching. If you think back to Chapter 1, we had that revenue recognition principle and expense recognition principle. We record revenue when it is earned, and we record expenses when they are incurred. As long as we do these two things, we are normally accomplishing matching. We're matching up revenues and expenses that go together in the same accounting period. For instance, if I cut your grass, that's always an easy example, so I tend to use it. If I cut your grass, the gas that goes in my lawnmower, the wages I have to pay my employees to cut your grass, all of those expenses I want to make sure are recorded in the same accounting period as the revenue that I earn from cutting your grass. Matching those two things up are the only way that I actually know, did I earn a profit? Did I charge you enough? Did my revenue outweigh my expenses? So matching is very, very, very important. So most of our accounts stay up to date just if we follow those two basic principles of accrual accounting. However, there are some things that we purposefully do that is going to mean that some of our accounts need adjustment. Therefore, we will have our adjusting entries. And like I said, remember, these are a planned part of the accounting process. It doesn't mean that we made a mistake and we're trying to fix something. Almost all companies have these, and they will do them at the end of their accounting process, at the end of their accounting period. So I've got listed here our 6 basic adjusting entries. And I'm going to try to give you some little hints on each one of these to make them easier to remember. First of all, just in general, on these adjusting entries, and I'm sorry, I've got a sinus infection, so if my voice kind of keeps coming and going, I'm trying to keep from coughing too much, and I know I sound kind of like nasally and congested, so I apologize. Just that time of year. On all of these entries, the debit and the credit will be the same every time. So what I mean by that is when we make our adjusting entry for supplies, every single time we will debit supplies expense, we will credit supplies. Every time we make the adjusting entry for supplies, that debit and credit will be the same. The accounts will not change. The debit and credit will not change. So that should make it a little bit easier if you can remember that. Now, how do I know what amount to use? Well, that's where it can get a little bit tricky because they change the wording on you. So what's very important for you to know is, what am I trying to record? Well, for instance, supplies. When we purchase supplies, they are an asset. They have value, correct? So they're an asset when I buy them. When I use them up, they become an expense. Think about that. I buy supplies. They're sitting there in my supply cabinet. They're an asset because they have value. But once I use them up, once I've used all the ink out of my pen, or I've already used that copy paper, or I've used those staples, they no longer have value. They're not an asset anymore. They become an expense when I use them. So when I make my adjusting entry, I am adjusting my supplies account to show that I have used up part of my supplies. So I'm going to be increasing supplies expense and decreasing supplies for the amount of supplies that I have used. Okay, so let me put a little note over here. We are recording the amount that we have used. So that will be the number that we use in our journal entry, the amount of supplies that we have used up, because that's what becomes the expense. Now, in some of your transactions, they will just tell you how much they have used. If they tell you how much they have used, then, I can't type, they are giving you the answer. So if the transaction says, during the accounting period, we used $1,700 worth of supplies, then they told you how much they used. That is the answer. So you would debit supplies expense, credit supplies for $1,700. Or they could tell you the amount on hand. If they tell you the amount on hand, that's telling you what is left. Anytime you know what you started with and you know what is left, the difference between those two is what you used up. So in that case, we would have to subtract. So they can either tell you the answer or they can word it so that you have to subtract. Used is the answer. If they tell you what's left, what's on hand, the current balance in the account, then you have to subtract. That makes sense? Always have to pause, give you a little second to think about what I'm saying. So remember, the debit and the credit will not change. It will always be a debit to supplies expense and a credit to supplies. What you are trying to record is the amount that we have used. You've got to become familiar with that wording so you know if they're giving you the answer or if you're going to have to subtract. Let's look at another one. This example is a debit to insurance expense and a credit to prepaid insurance. So we are recording the amount of our prepaid insurance that has been used. When we buy insurance ahead of time, we record it in that asset account, prepaid insurance. When we use it up, it is going to become insurance expense. Kind of like supplies, right? It was an asset, we use it up, it becomes an expense. So the amount that we are recording is going to be what? Whoops. The amount we have used, just like on supplies. So once again, it's about the wording. If they tell you the amount of insurance that we have used, they will normally use the word expired. So expired means used, and that is the answer that we are looking for. So you don't have to do any subtracting. They're giving you the answer. Unexpired is what we have left. And anytime they tell you what we have left, then you're going to have to subtract to figure up how much we used. You're always going to know the beginning balances. Normally that's going to be our starting point, is a trial balance. So we know what the prepaid insurance was to begin with. In other words, we know how much we bought. Say we bought a 24-month policy for $1,800. And then they will tell you the amount of unexpired insurance at the end of the period is $1,000. So we started with $2,400. Now we have $1,000. Well, apparently we used up part of that insurance, correct? How much did we use up? Well, the difference between 2,400 and 1,000, we subtract. And the difference would be how much we have used. Now, I'm just typing on these lines right here. I'm not trying to make this look like a debit and a credit. I've just got 2 lines to type on for each entry. The number will be the same. We're recording the amount that we have used. I'm just typing different bits of information on each line. In class, I typically use a pizza example. I will say, you know how if you're studying for an accounting test, right? But you get hungry, and so you stop and you order a pizza. You don't keep up with how many slices you're eating. You're just studying and eating, because you're studying so hard, right? I know you are. So you look down, and there's only 3 slices of pizza left. You don't know how many you ate, but you know there's 3 left. And if you're a pizza connoisseur, you know that a large Domino's pizza has, I don't know, 8 slices. If it has 8 and now there's 3 left, how many did you eat? You ate 5. So, same concept for figuring out how much supplies we used or how much insurance we used. Remember, insurance just tells us what we're talking about. This could be interest expense and prepaid interest. It could be rent expense and prepaid rent. We treat anything prepaid the same. Let's talk about unearned for a second. Unearned could have any revenue account to go with it. Unearned revenue, fees, revenue. Unearned rent, rent, revenue. Unearned fees, fees earned. Unearned interest, interest, revenue. Anything unearned could have a corresponding revenue account. I say dog food, unearned dog food revenue. Those are just descriptions. The fact that it's unearned tells us how we're going to treat it. So you're looking for those key words like prepaid and unearned. The word that comes after it just tells us what it happens to be. But prepaid and unearned are the really important words. They tell us how we figure out what we're going to do. So, anytime we're making an adjusting entry for anything unearned, we are trying to record how much we have. Let's see. Let's just type this one down underneath, since I kind of already got a room over here. We are recording how much we have earned. Because remember, when somebody pays us before we do the work, before we provide the service, we have to record it in that liability account, unearned fees, unearned rent, unearned something. And that's a liability because we haven't earned the revenue yet. And remember, by definition, we record revenue when it is earned. So now it's the end of our accounting period, and we have earned part of this. So we're trying to record how much we have earned because we're going to take it out of our liability account and put it into our revenue account. This debit decreases a liability and increases a revenue. So the number we're looking for is the amount that we have earned. So once again, the wording. How will we figure out the wording? Well, they can tell us how much we have earned, and that is the answer. So they can tell us the amount we've earned, and that is the answer. Or they can tell us the amount that is still unearned. This is starting to sound familiar, right? Either they tell us the answer, or they tell us basically what's left. Anytime they tell us what's left, the amount that's still unearned in this case, we have to subtract. So there's kind of a pattern here. Wages expense and wages payable. Once again, this could be something else. Interest expense, interest payable. Any type of accrued expense, we would treat the same. So we've let the expense build up and build up because we don't sit there and record our wages expense every minute our employees are at work, every hour they're at work, not even every day at work. Now, granted, we're keeping up with it somewhere so that we're going to know how much we owe them, but we typically don't make a journal entry until we're ready to do payroll. So that's all well and good unless our accounting period ends in the middle of a pay period. If our accounting period ends in the middle of a pay period, we've got to go ahead and record the fact that we owe them so much wages expense at the end of our accounting period. Because remember, this matching concept, we've got to record all the expenses that happened in this accounting period. We've got to record them in this accounting period. So even though I don't normally pay my employees until Friday, if Wednesday is the end of my accounting period, then on Wednesday, I've got to make an adjusting entry and go ahead and write down in my accounting records how much wages expense I have accumulated or that has accrued up to this point. Normally, they will just tell you how much the accrued wages are, and that is your answer. There are a few examples in your book where they give you this long drawn out example about we normally pay our employees Friday on for a 5-day work week. We pay them $1,000 a day. Our accounting period ends on Tuesday. Well, if that's the case, we've got to stop and make an entry on Tuesday. So we're going to owe them for Monday and Tuesday. So that's going to be how much? $1,000 a day times 2 equals $2,000. In some of these examples, they can just change 1 or 2 words. And so it can be kind of tricky to know, do I subtract? Are they giving me the answer? On wages expense, it's not very tricky. Accrued wages is the answer, or else they give you this big drawn out example more than just changing a couple of words. So it's pretty easy to know when you have to calculate it and when you don't. But remember, you are looking to record the amount of wages that have accumulated or built up. And I didn't type that, did I? I apologize. Let's type that. We are recording the amount of wages that have accumulated or built up at the end of the accounting period. I cannot type today. Y'all are making fun of me, aren't you? I can feel y'all laughing at me. That's okay. You can laugh at me as long as this is helping you learn. I don't even care if you laugh at me. Okay, so the next one, accounts receivable, fees earned. And you got to think, when I'm doing this, I'm like writing on the board, not typing. So y'all got to cut me a little slack. Accounts receivable and fees earned. Normally, as we earn revenue, we just record the fact that our customers owe us as we earn it. But let's just say there's some reason that we have put off recording the fact that our customers owe us money. Maybe we made an arrangement with our customer that we wouldn't bill them until a job was completed. Say the job started in October and is going to end in February. You know, the famous lawyer commercials. We won't collect a penny from you until we win your case. Well, maybe the case goes over from one accounting period to another. We start in October, we end in February, but our accounting period ends in December. Well, if that's the case, we're going to have to stop and make an adjusting entry because October, November, December, those 3 months are in one accounting period. January and February, those 2 months are in a new accounting period. So those revenues are going to be separated and recorded in the appropriate accounting periods. So we need to record, there I go again, recording the amount that has already been earned but not billed to customers. So we've already earned the revenue, but for whatever reason, like I said, we have not billed our customers. But now it's the end of the accounting period, so we've got to stop, make an adjusting entry, bill our customers. It's the same old entry we normally make. Debit accounts receivable, credit fees earned. And normally they will just tell us accrued fees, and that is the answer. Okay. Depreciation expense. Well, remember depreciation, I'm assuming you've looked in your book about depreciation. Depreciation is the way we record the amount of a fixed asset that we have used up. Supplies, it's easy to tell how much we've used up. The copy paper was there and now the copy paper's gone. The staples were there and now the staples are gone. Depreciation, okay, a tractor. I always say I want to be a farmer when I grow up, okay? So, say I've got my tractor. Well, we know that my tractor is only going to last so long, right? A car is only going to last so long. A building, it's not going to last forever. But it's not like I'm driving my tractor and every time I drive it, it slowly starts disappearing on the back wheel. And every time I drive, it disappears a little bit more until one day, poof, my tractor's gone. Doesn't work that way, right? So even though I know I'm using it up, how do I know how much I've used up? A copy machine, only going to last so long. Every time I make a copy, I'm using it up. But I can't see it disappearing. So reading your book about depreciation, depreciation is the way that we turn the cost of a fixed asset, an asset that lasts for several periods, into an expense. There's several different methods, and we'll talk about those more later. This is our adjusting entry. Debit depreciation expense, credit accumulated depreciation, dash tractor, dash building, dash truck, whatever asset we are depreciating. The amount that we are looking for is the amount we are depreciating for this accounting period. This is going to be given to you at this point because we have not learned how to calculate depreciation yet. Just so you will know, this accumulated depreciation account is a contra asset account. So it's listed with your assets, but it's a contra account. Contra accounts have the opposite balance of the normal. So normal assets have a debit balance. A contra asset would have a credit balance. So accumulated depreciation is a contra asset. So it's going to be increased by a credit and have a normal balance of a credit. We will calculate what is called book value. Book value is equal to cost minus accumulated depreciation. So I've got the cost of my tractor minus accumulated depreciation on my tractor. Well, every year when I make my adjusting entry, I will credit accumulated depreciation. So the balance in that account will just grow and grow and grow. So that represents the amount of my tractor that I have used up. So book value, cost minus the amount that I have used up. So how much I have left, right? The value on my books, my accounting records, the value of my tractor to me. Depreciation can be a little confusing. And like I said, we're just kind of talking about the very basics right now. We're going to have a whole chapter later on about depreciation, chapter 10. So, questions on your adjusting entries. Think about it. Use your book, use your PowerPoint, use this video, work on your homework, look at your chapter, let me know what questions you have. Just to summarize, the debits and credits don't change. It's all about understanding the wording. What are we trying to record? For supplies, the amount that we have used. For unearned, the amount that we have now earned. Okay, let me know what you think. Remember, I'm here to help. I'm here for questions. Just let me know.